And before we get into this one, we'd like to remind you, please, like, share, subscribe. Your support is appreciated. Now, when we turn to the U.S. Product supplied, so this is looking at demand levels. So we just want to look at, okay, what is happening with demand? And when we look at the current, so the current went to 14.792 million versus 14.26 the week before, which is putting us at an average of about 14.4 million over the rolling 4 weeks. So when you look at what has happened so far, we've essentially just gone flat. And a lot of this flatlining, so we were expecting a little bit of a pullback to closer to about 14.2, but the gasoline number, obviously Colonial, that we changed that last week as Colonial pulled forward that demand. But even when you look at Colonial pulling forward this huge chunk of demand, we're still well off of where we were in 17, 18, and 19, which is why when you look at, okay, well, everybody's now open for the most part. Things are still opening in some areas, but a lot of the high driving areas have been open for a long period of time. And by long period, I mean the last 2 months. And now you're getting some of this increase, but again, where is that increase happening? And we're going to go through what does the price of gasoline really mean? In previous years, the view was 350. 350 was kind of that level where that's the pain point. That's when people look at that tank and that gas and say, okay, how do I figure out how to drive less to save 1-2 gas fill-ups a month? We've been saying it's much closer to between 3 to 315, where that's the new pain point. And the reason why is because you have inflation elsewhere, you have increasing in pricing in other parts of people's lives, and that pain point is just moving further and further down. And we're at this pivot where I think you're going to start to see more demand destruction, especially when you look at who's taking trips, where are people driving, and that's what we're always trying to kind of touch on to look at how is this recovery really progressing. And then when we look at, again, just to reiterate some of the exports, so exports of European products on the transatlantic route are set to be about 3.34 million tons so far in May. And when we consider what does that look like? So right now, 60 tankers that have arrived with 2.3 million tons, plus another 23 tankers that are booked for another million. So based on the arbitrage, we should see some of that continue. So we will see an upward move on what is on this transatlantic route, just because you do have some premiums in the New York Harbor on the East Coast, which is going to pull some of that through. Now, with the East Coast in mind, yes, this is talking about East Coast, but as we said before, we had a huge increase in May shipments from Asia, and that's something that we think is going to trend higher, especially when we turn to Pad 5 and just what the margins look like over there. So now that we've kind of looked at this in general, let's break it down more specifically. Let's look at distillate. So here you can see distillate had a draw of 2.32 million. Taking us down to the 7.5 million below the 5-year average. But the biggest issue here remains Pad 1, where Pad 1 had a build of 1.22 million. And Pad 3, and Pad 1 had a draw of 2.9. So it's this unbalanced move where Pad 3 continues to see these increases. And again, when you look at total storage, typically this is when we start to see some builds, and you're seeing some counter seasonal draws, which is a net positive. But as we said last week, we expected draws just at a slower rate of change. Now, this was a bit faster rate of change when you look at just the slope, only because you had this shift in activity, just given, trying to pull some recovering more kerosene. Because when you think about kerosene can easily be dumped into the distillate pool, kerosene being jet fuel. So now you'll get some of that recovery, some of that pull through in general. And again, that'll take some of the additional out of the distillate stock. Imports, was one where we actually had a fairly big increase in imports. Net, it was only 59,000 barrels a day, but 135,000 into Pad 1. So when we say big, when we look at the 5-year average, it's actually 147,000 over the 5-year. And just based on what we're seeing coming into the market, that seems fair. It's going to be, the imports will remain fairly elevated coming into pad 1. Now, when we look at what is going to come into pad 5, that's where we see a bigger upside in terms of imports. Now, when we look at just yield in general, in terms of what are the refiners trying to focus on, they're still trying to create as much gasoline as possible. So the gasoline yield increased 2.6%. And if you remember, we said that there was, the shift had already really happened in pad 3, but it accelerated in pad 1. So a large part of that actually happened in pad 1 and pad 2. With pad 3 turning, there were some assets that were down, and they've actually been down since the Texas freeze off. Those are now back. So it was less about new yield. It was or shifting yields. It was just new equipment coming back to add to the gasoline cut. And then on the other side, when you look at production of distillate, it was actually down 0.86% because, again, they're trying to shift and trying to capture that gasoline margin. So distillate draws will continue overall, just as you have more recovery of kerosene and the focus on creating more gasoline and more aromatics, more octane. So when we look at that demand levels, one of the things that we were saying was, for distillate in general, hanging right around the 5-year, we're right here. There's really nothing to say we're going to get a big surge up or down. We know that trucks will remain very robust. We're going to see a lot of movement that's going to continue. In the econ show, and we talked about it in the FSC show, we showed the amount of activity that we're seeing in trucking. That's going to continue. Again, that'll keep us above the 5-year average when we're looking at what is the activity in the distillate market. And when we talk about trucks, here you go. The load availability is essentially flatlined, which when you see load availability flatline, that's when you're going to start to see some of that demand index come down a bit. Nothing too crazy one way or the other. The one place to watch is going to be that steady rise of rates, because we continue to see upside to general rate activity. And it's just that pass through on labor, because there's such a shortage. So you need to pay people to come and do and essentially take as much product as possible. So you need to pay them. And we're seeing an increase in sign-on bonuses. And at the same time, the increase in diesel prices is going to increase and push through rates. On the rail side, rail remains fairly strong, especially when we look against just that, going back a bit further to 2019. And there's a huge backdrop of the shortages that remain in inventory, sales ratios, things that we're going to talk about in the econ show still remain very, very low. So we still need to see that recovery. But when we look at grains, when we look at forest products, those are the things that will remain elevated. And then the issues that existed on the Mississippi, for those that saw that crack that was in a bridge going over the Mississippi, shutting things down, we will continue to see petroleum and petroleum products on rail a bit more. There was a derailment, which it should be nominal in terms of the impacts. But again, those are the risks that we have when we're not moving stuff by pipelines. But here's where, when we start looking at intermodal is still going to remain elevated. We're still seeing, at this point, low double digits, just because we do need to see more and more coming through, more activity, and just that refill of inventory. And when we think about inventory, and this is where we start talking about inflation as we continue to import it, we still have a ton of cargoes sitting on our coast, still waiting to come through. And this is just what's already on our coast. And then when we go back through the supply chain, container rates are up. PPI is up in China, in Japan, in South Korea. Again, all of those things are going to feed down. So this is still just things that were already purchased. They were purchased at lower prices. So prices are going to continue to push higher when we look back through the supply chain. And you can see just how difficult it is to catch up. And it's better to look at, obviously, the week over week, because year over year was COVID. But these week over week numbers continue to shift higher. And especially when we go through June, you're getting this additional surge. And this is going to keep everybody very active. And again, the shortages that we continue to see on the container side is going to keep those prices very elevated on container rates, as well as just those shipping rates especially when you start looking at crude pricing. We're going to get a nice little heat wave coming through the East Coast and into the Midwest, which this could have an issue when you look at droughts on what's happening within the breadbasket states. And those are things that we'll talk about going forward as we get new data on drought components. But realistically, this is showing that you're going to get a big increase in, or not a big increase just because we're still in May, but you're going to get an increase in cooling demand. And we saw that get priced into the natural gas market. You saw this big spike in front month cash in the cash market, as well as the futures market. And again, those are things that are going to be pulled through. When you look at this, clearly we're not going to have any more heating oil demand from that perspective, obviously for hot water, but that's where this piece is now officially gone. We've now moved into the spring season that were realistically, based on some of the numbers that we're seeing, the summer months. So now when we shift over to gasoline, gasoline had a draw of 1.96 million. It's 5 million below the 5-year average. You'll be shocked to know it was in Pad 1 that had a draw of 4.58 million. Pad 2 had a residual 1.73 million draw, with Pad 3 a big build of 5.73 million. The one that we continue, so Pad 5 had a draw of 1.03 million. That's now in line with the 5-year average. That's going to remain elevated as those imports come through. Pad 3 is obviously going to be the one to watch, especially given the pull through of demand that we've seen in Pad 1. We expect to see an increase in storage in Pad 1 as it drains from Pad 3 to Pad 1. But even with this big disruption, I just want to point to where we are in the 29-year chart. So as we've been saying, we're just going to go sideways. And that's where we continue to sit. We're just going sideways. Yes, you obviously had an acceleration to the downside, but we're not seeing any real draw. And it's all coming from not only are refiners maxing out the amount of gasoline they can create, but you also have that big increase of imports. So imports were up again, 146,000 barrels a day, driven by Pad 1 coming into increasing 188,000 barrels. So on the net level, we imported 1.08 million barrels a day of gasoline, which is 210,000 over the 5-year average, just based on what we're seeing, the acceleration. We'll most likely see a decline week over week. But when you look at the 4-week trend, it's still up. There's still a lot of cargoes coming through, and Pad 5 had a decline of 26,000 barrels a day. That's the one where, while Pad 1 will remain and continue to take in cargoes, Pad 5 is going to be that sleeper where you're going to see a big increase in imports overall. Now, when we look at blending components, they were down 1.63 million, but it's only 2.8 million below the 5-year average, because that the shift is making summer grade gasoline, because that's where you're going to get some of your margin. That's where you're going to get some of your octane. But we still see some of this friction. Now, getting into some of the Gas Buddy data that I thought, they did a really good job of kind of highlighting, and obviously they have a huge membership. So this is looking at the next few slides are looking at a survey that was of 186,000 Gas Buddy members from May 3rd to 5th. So according to Gas Buddy data, as we talked about, the demand continued to fall. We're down about 17.3% week to date, but Memorial Day gas prices. So right now, the projected Memorial Day for Gas Buddy is saying $2.98. I would argue it's going to be a little bit higher. They're assuming that there's going to be a little bit of a decline as things start to normalize. Very possible. I'm of the mindset it's going to be between $3 to $3.05. So if I had to put a number on it, I'd say $3.03. But 46% of Americans say high gas prices are impacting travel decisions. And I think 46%, so half of the people that were interviewed or that took this survey are saying that gas prices are having an impact. And if you just think about the percentages, that's a lot of people that are weighing what is the price of gasoline and where am I driving? And I think this is that change that we're seeing in terms of how are people consuming. So then when we look at high gas price impacts consumer decision to travel, and this is no gas prices are irrelevant, and then if you look at who said that, so in 2021, 53% said gas prices are irrelevant. I'll do what I want. Yes, they're low. I want to take advantage of it. Obviously, they're not low anymore. So that's where you could see the big shift between 2020 and 2021. But then, yes, they are too high. When we look at 2019, who said 38% said that, now you're at 46%. And if you just look at the trend in general, it is really for gasoline prices to remain elevated or push a bit higher. So as you start to get closer to 310, 315, that's when I think you see that big drop off. So it's really not 350. It's much closer to 310, 315, where you're going to get that bigger pivot. And then when we look at impacts, COVID-19 impacts American summer travel plans, not booking international travel. Obviously, 2021, there's less people saying that. It has not impacted my plans. That is, less people are saying that it's impacted their plans. That makes sense. The one shocker or the one interesting one for me was taking fewer road trips. In 2021, they're saying that people are taking fewer road trips. And I think that's going to be interesting because as people have more freedom, or maybe they're going to take, doing things a little bit differently. But how much of that is driven by just what is the price of gasoline? And I think that is becoming a bigger component of it, because when you look at, taking fewer road trips, but making shorter trips by distance, I think that is going to increase as well, especially as they're looking to say, look, I could drive 4 hours or I could drive an hour and a half. Which one am I going to try to do? I can still get away, but maybe I'll be able to save a bit on just what's happening in the market, especially when you look at gasoline prices. And I think that those are important things to look at. Now, when you factor in what we're seeing today in gasoline prices, so as of May 17th, they were at $3, almost $3.03, up $6, almost 7 cents. This is the one that, and again, you typically get that push into Memorial Day weekend. I just think it came early because of Colonial, and it'll just stay sticky. It's not that I'm not saying it's going to go up any further. I think it's just going to stay in this level because they can essentially say, look, it's already there. I have to try to recover some of the pricing because I'm paying more for trucking. I'm paying more for logistics and movements. So I'm just going to keep it flat. I don't really see a big push higher going into it. So I think that we're just going to be right in this range. And when you look at the West Coast, the West Coast Pad 5 is at $3.67. That's why I think, again, that support for pulling more product, especially when you start looking at spreads in general. Now, on the diesel side, you had an increase of 6 cents. We're now at $3.25 for diesel. This is the one where this could pare back a bit. You could see a little bit of a normalcy, especially as you start to see some of the diesel coming back into the system. It's still going to be elevated. And I think by it still remaining elevated, that's where, again, some of those prices on just inflation cost to the consumer is going to remain high. Now, gasoline prices is where people are going to see the most pain. And that's where I think you're going to see that change of just the activity levels. And now when you look at the blending components, as we just assumed limited rate of change. And when you look at this chart, that's exactly kind of what you're seeing, where we're just going flat at this point. And just as things normalize, again, you're going to start to see that build up that will happen over the next 2 to 3 weeks. So now when you turn to the last 15 years of gasoline demand data, we're right on the 15-year average, slightly above. And when you look at that rate of change, again, we typically have that rally into Memorial Day. Then you have the pullback as people, still have another 3 or 4 weeks of school. And then you start to see that recovery as activity increases for summer. This is one where, again, we expect to see that pullback off of the highs, just because you're going to have things normalize. Now, when we look over the last 5 years, obviously 19, 18, and 17 and 16, here you can see that, yes, gasoline demand is at 2021 highs, but a lot of that is Colonial Pipeline pull through. But even with the Colonial Pipeline, we're still off of the low point that we had in 2019. And then this is why I think we're going to get this move down. And I don't think we'll take out the low from last week, but I think we're going to come back to that low point of about, let's say between 8.8 and 8.9 million. We could get, and I'm not saying that we do, my base case is that we pull back. We could get one more number of an increase just because of the way it's calculated. I don't think it will, just because there's a lot of people that are driving much less or limiting travel, just because they still see the fact that there is a very, very, very empty stations near them. So that's why I think we'll get a drop down. I don't think, and because they'll get a little bit of a buffer, that's why I don't think we'll take out that low. But again, moving back down to that low point. Now, wrapping it up with propane, here you can see that we had a build of 410,000 barrels. Tracking, we had a little bit of a flat line, but I think we start to see that acceleration. We're 10 million below the 5-year average. I think 2017 remains kind of a good pivot point in terms of watching where things are going. And then when we look at U.S. activity, as of May 14th, you can see that we had that nice drop in new COVID cases, new COVID deaths continuing to move lower. All of that is very exciting stuff. But when we look at lockdown index, we're still coming down. We're now below 50%. It's just that's going to accelerate over time. It's just how many people are actually paying attention to it is always the different side of it, because right now we know that the government has said something, but how many people are actually paying attention? Now, when we look at what people are doing in the U.S., you can see obviously parks are becoming a bit more activity. Residential, you're still seeing a lot of some decent work from home. And the reason why is because you can look at the workplace. So the workplace is flat, residential is flat. But there are people going to the office. And the one that I find interesting is transit stations. We're getting more and more people going to transit stations. And I think it's those that don't want to drive because there is more traffic. I'm not saying there isn't. There is more traffic. So if I'm vaccinated and most other people are vaccinated and I'm going to the office, well, I'll throw on a mask, which, in New York, you still have to on transit. And, I'll deal with the transit side. So I think you're going to continue to see that creep higher. The interesting thing that we see here is on Apple data, it's still fairly flat on the US side, obviously with a higher low, but still within that range. The ones that we continue to see that trend up, Germany, Italy, UK, and this is where we see this kind of flatlining activity in general. And then when we look at vaccines, the interesting one is the US. So you can see the US drop from 0.66 to 0.53. And now you're seeing this slowdown because people either got their vaccine that wanted it, people that don't want it won't get it. And that's where we're seeing some of this friction point. And that's why I don't think the US drops much further, but I think it's going to hold at about this 0.5 level. The bigger concern is India. So India has actually had a slowdown in vaccinations, which is causing some friction in terms of, well, how quickly can they get vaccinated? In Germany, Germany has been fairly strong, France as well. We're hoping to see that accelerate some more, but India is going to be the bigger problem. And then when you look at India, and the other problem is, look at this chart, and how many Asian countries do you see on it? And that's where we continue to see a very slow rollout of vaccines in South Korea, in Japan. And that's where, when we look at activity levels, Asia remains the headwinds in terms of that normalcy. Now, when we talk about jet fuel, Jet fuel had a build of 820,000 barrels. We're now right at the 5-year average. We're 300,000 below the 5-year average, but again, right there. As we were saying, we expected a pullback. We just expected it to, let's just say retrace half. We're estimating about 1.1 million, came in at 1.186. We just think that, again, it's going to stay within this flat line level because we do have some more TSA passengers coming through, but we're still not seeing a huge increase in departures because they're just putting more people on these planes, trying to increase profit. Obviously, that's going to be a big focus at this point. And that's why when we look at flight departures on a global level, it's actually come down. And that's why when we look at the North America, so North America had a little bit of an increase. Now we're flatlining. Asia Pacific had a pretty big decline, and Europe has flatlined a bit. So when we look at average departures per day decreased by about 340 week on week. Year-on-year departures were up, 16,000, obviously with COVID. But India, China, and Vietnam led the declines while the U.S. led the growth. And this is going to be that pivot point where I think now you're going to get to companies adding back departures for Memorial Day for that last little push, where you're seeing a lot of that slowdown in Asia Pacific. And I think Europe and that rest of the world is, again, going to go flat at this point, which is going to put those headwinds. Now, when we look at activity, here you can see, just looking at 19, you can see that we normally get this bump almost exactly at the same time. So there's some seasonality with it, but we're still above that. If we take the average of 19 and 20, we're still above that average. We're still trending a little bit higher than what my expectations were. I was assuming about 1.3 on an average. We're much closer to about 1.45. So we are getting a little bit more pull through, which is a positive. But here's where you can see kind of that normal pivot that we will see after Memorial Day. There's a Memorial Day bump, and then you get that movement higher. So this is going to be something to watch in terms of additional passengers. And then the question will be, how much of it is just additional onto one plane or requiring a brand new plane? And now wrapping up with OpenTable, not much to say here. We're getting a little bit more activity on the weekends, not all that surprising. A little bit more on the weekdays as we're getting, Canada, Germany, Ireland starting to get more active. The UK is now positive. Mexico is now positive. So on a global level, expecting to be actually a little bit better on the weekend side. I'd say we're only going to be down 10% versus the previous. And then same thing on the weekdays, only down about 25% on those weekdays levels. And that's where you're starting to see that here, where the trend is still up, slightly higher highs, slightly higher lows, all moving in the right direction when we're looking at general activity levels, which again will be a net positive when we're thinking about, people moving about, getting back in there. But when we look at jobs, we're not getting, you still had companies that went bankrupt, things that were slow. So, when we turn to the econ show, we're going to talk more about how is this impacting jobs or not impacting jobs and creating some of those, consistent headwinds. But in the next segment, we're going to go more into the Asian markets and the global market to look at how things are pivoting and moving around a bit and how this product is moving about the world.